Hi there, I'm Suk Day. I'm a chartered accountant and an MBA. Accounting for pensions frequently appears in professional accounting examinations. In this tutorial, I'll explain the accounting requirements for defined contribution pension plan, defined benefit pension plan, and how to account for the asset ceiling. Pension plans are post-employment benefit plans for employees after their retirement. The accounting requirements for pensions are outlined in IAS 19 Employee Benefits. There are two main types of pension plan: defined contribution plan and defined benefit plan. Let's talk about the defined contribution plan. Defined contribution plans are benefit plans where the entity pays fixed contribution into an independently trustee administered fund. The entity will have no legal or constructive obligation to pay further contributions if the fund does not hold sufficient assets to pay all employees' benefits relating to their service. If the business matches the timing and amount of their contributions to their obligation for each accounting period, it is not necessary for it to recognize any further liabilities. Let's talk about the accounting requirements. The accounting entries for contributions paid by the entity are to credit cash and debit the operating expenses account. At the end of the accounting period, the balance on the operating expenses is transferred to the profit and loss account. Assuming the correct contributions have been paid into the scheme, no liability would be recognized in the statement of financial position. Let's talk about the defined benefit pension plan. A defined benefit pension plan is a plan in which an employer guarantees a specified pension payment per month when the employee retires. The word specified means it can either be a fixed payment every month or it could be linked to an inflation index. The payment is predetermined by a formula based on the employer's earnings history, tenure of service, and age, rather than dependent directly on the investment returns of the individual pension's assets. What that means is that if the pension obligations exceed the pension assets, the company will have to make good any shortfall. The way it works: both employee and employer makes an agreed contribution per month until the employee retires. A trust is created to manage the pension scheme, but the pension obligations or liability and pension assets at each financial year end date is shown in the entity's financial position. If we look in the diagram here, we can see that the accounting for defined benefit pension plan is more complex in the sense that we have three financial statements involved: the statement of financial position, the other comprehensive income, and profit and loss account. The other comprehensive income, or OCI, will record any remeasurement gains or losses of the pension obligations and liability and pension assets at the end of each financial year. The profit and loss account will show the agreed annual pension benefit, and it's sometimes described in the accounts as a service cost earned by the employees. As this is payable in the future, that future payment will be discounted to a present value. The profit and loss account will also be charged and credited with an interest component calculated on the opening balances of the pension obligation and pension assets, respectively. The net interest, which can be an expense or an income, is shown in the profit and loss account. The corresponding entries are added to the pension obligation account and pension asset account, respectively, shown in the balance sheet. In this slide, we will look at the accounting entries that are posted to the defined benefit obligation account. We start with the opening balance. To that we add what is the current service cost. The current service cost represents the value of 1 year of pension benefits payable in the future discounted to present value. This increases the defined benefit obligation and is charged to the profit and loss account, i.e. operating expenses. Past service cost. Past service costs are additional pension benefits arising from plan amendments. The accounting treatment is similar to current service cost, increases the defined benefit obligation and charge to the profit and loss account, i.e. operating expenses. The next is interest on the opening defined benefit obligation. This represents the increase in present value of defined benefit obligation due to the benefits payout being one period closer, calculated by multiplying the opening balance of the PBO with the discount rate, and again is expensed to the profit and loss account, i.e. to the interest account. Curtailments is a reduction in the pension benefit obligation. This occurs when significant number of employees leave the scheme as a result of company restructuring. The corresponding entry is to the credit of the operating expenses in the profit and loss account. Benefits paid. Benefit payments to scheme members reduces the pension obligation, also at the same time pension assets. Remeasurement gains or losses on obligations arises from the remeasurement of the defined benefit obligations at the year end. It happens due to the fact that the obligations are remeasured based on actual assumptions, and the corresponding entry is in the other comprehensive income, as these are unrealized gains or losses and dependent on actual assumptions. And finally, we got the balance at the year end. Now, in terms of where these entries end up in the financial statements, the current service cost, the past service cost, the interest on the opening defined benefit obligation goes to the profit and loss account. Benefits paid. This is a contra entry with the pension account because, as we said earlier, the assets has to be realized to pay the benefits. Remeasurement gains or loss on obligation or pension obligation. This appears in the other comprehensive income because they are unrealized gains or losses. And finally, the defined benefit obligation at the end of the year goes to the balance sheet. Right, in this slide, we will look at the accounting entries that are posted to the defined benefit asset account. Start with the opening balance. To that we add the interest on the opening plan assets. This represents income on plan assets associated with the passage of time during the year. This is calculated by applying the same discount rate used in pension obligation interest calculations to the opening balance of the plan assets. This notional income is credited to the profit and loss account, i.e. interest account. Contributions by employer. These are amounts paid by employers to top up pension assets where there is a large deficit between pension obligations and pension and plan assets. Benefits paid to scheme members reduces the pension assets. Gains or loss on plan assets excluding interest occur as the pension's assets are revalued at the end of the year. These gains or losses are recognized in other comprehensive income. Finally, we end up with a fair value of the plan assets at the end of the year. Let's review where the countries end up in the accounting records and financial statements. Interest on opening plan assets or income goes to the profit and loss account. Contributions by employer, this is a contra entry in the cash book. That's amounts paid and debited to the pension benefit asset account. Benefits paid is a contra entry with the pension benefit obligation account. Gains and losses on plan assets, this goes on to the other comprehensive income. Finally, the fair value of the plan assets at the end of the year goes to the balance sheet. Let us summarize where the defined benefit pension plan accounting balances are shown in the financial statements. We start with the statement of financial position of balance sheet. We have the balance on the pension benefits asset account at the end of the year, which is an asset. And against that, you offset the pension benefit obligation or liability account. And those two are netted off. And we will either get a net pension deficit where the obligation of the pension obligation or liability is more than the pension assets, or we have a net pension surplus where the pension assets exceed the pension obligation or liability account. If there is a net pension deficit, it will be shown under non-current liabilities, and if there is a net pension surplus, then that would be shown under non-current assets. The other comprehensive income, or OCI, has two sections. Items that will not be reclassified to the profit and loss account, and items that will be reclassified to profit and loss. The remeasurement gains or loss on pension obligations at year-end appears under the items that will not be reclassified to the profit and loss account, and so is the gain or loss on pension assets, excluding interest at year-end, is shown here as well. The next financial statement we'll look at is the profit and loss accounts. Under operating expenses, we have what is called the current service cost. If you remember, this is the value of 1 year of pension benefits payable in the future discounted to present value. And the contra entry for that is in the pension benefit obligation account. Curtailments, if you remember again, is a pension curtailment is a reduction in the pension obligation of the entity. It reduces the pension cost for that year, and the corresponding entry is to the credit of the operating expenses. Under finance income and expenses, we show the interest on the defined pension asset, and again the contra entry for that is in the pension benefit asset account. And also we show here the interest on defined pension obligation, which is the cost, and the contra entry for this is in the pension benefit obligation account. What happens is the interest on the defined pension asset and the interest on the defined pension obligation are netted off, and there is either a net interest expense or income. Let us attempt an examination question on pension accounting for a defined pension plan. Pause the video here and go through the data on the defined pension plan provided. What is required here is for the students to show the amounts that will appear in the financial statements at 31st December 2019 for XYZ PLC. The data you're given are the closing balances on the pension assets and obligation at 31st December 2018. You're also given information relating to the year end of 31st December 2019, such as the current service cost, the past service cost, contributions paid in by the employer and the employee, benefits paid out to employees, the fair value of the pension assets and pension obligation at the year end. The yield on high corporate bonds of 5% is used to calculate the notional interest on the opening balances of the pension obligation and the pension asset account when you are preparing both the accounts. The approach in answering questions on pension defined benefit plans is to prepare your workings in the following order. First is to write up the pension obligation account, followed by the pension asset account. Once you've done that, you can use the information in the two pension accounts above to calculate the amounts that will be posted to the following financial statements: profit and loss account, other comprehensive income, and the balance sheet. Right, our first task is to write up either the pension obligation account or the pension asset account. We'll start with the pension obligation account. The first entry is the opening balance, which is the value at 1st of January 2009, which in the question is 66. The next is the current service cost in 2019, 9. The past service cost, which is 8. The benefits paid out, which is 6. And this is a deduction in the sense that it reduces the obligation. And finally, you calculate the interest of 5% on the 66 million on the opening balance, and you end up with 3.3 million. You add them all up and you get 80.3 million. Now, the next thing is to work out the remeasurement gain or loss. Now, to do that, we have to work, what we do is to put the fair value or the balance at the year end of the pension obligation, which is given as 77. Now, you take the difference between these two. Given that the obligation at the end of the year is less than the total of 80.3 million, this amounts to a remeasurement gain, which is 3.3, and is taken off from 80.3 million to arrive at 77 million. The next account you write up is the pension asset account. Start with the opening balance, which is 62. The contributions paid in by the employee and the employer in the question is 5. The benefits paid out reduces the assets, pension assets, and that is 6. And finally, we calculate the net interest of 5% on the opening balance of 62 million to give us 3.10 million. You add them all up to get 64.10 million. The next thing is to work out the remeasurement gain or loss. To do that, we take the fair value given at 31st December 2009 of the pension assets, which is 65, and given that this is higher than the total added up of 64.10 million, this gives us an effective gain of 0.9 million. We use the information in the pension obligation and the pension asset account to report the amount to the financial statements. We start with the balance sheet. Now, we get a net in the balance sheet. We post the net pension deficit or surplus. For that, we look into the balances at the year end, which is 77 million for the pension obligation and 65 for the pension assets. So there is a deficit of 12 million. This is shown under non-current liabilities. We next look at the profit and loss account, and essentially again items in the two accounts will either go to the operating cost or the finance income or expenses. We start with the current service cost, which is 9. We start with the past service cost, which is 8. And we total them up, we end up with a figure of 17 million. We next look at the finance income and expense. We start with the interest on the pension liability, which is a cost, the opening balance, which is 3.3 million. And we look also at the interest on the pension assets, which we have calculated to be 3.10 million. We net them off and we end up with a net interest expense of 0.2 million. Completed the profit and loss account. Now we will move on to the other comprehensive income. Items that will not be reclassified as profit and loss accounts will be the remeasurements of the defined benefit plan. The first, we've got the pension obligation remeasurement gain, which is 3.3 million. And then we've got also the pension asset remeasurement gain, which is 0.9 million. And that gives us a total of gain of 4.2 million. We've also done the balance sheet in the previous slide, and that completes the answer to the question that we set ourselves. In this slide, we will explain what is meant by the term asset ceiling test and how it is accounted for in the accounting records and financial statements. In the balance sheet, the balance on the defined pension asset account and the defined pension obligation account are netted off, and there is either a pension surplus or a pension deficit. The asset ceiling test applies only where a pension surplus belongs to the plan members, or the IAS 19 states that the amount recognized as an asset may not exceed its recoverable amount. This amount is measured as the lower of the surplus of the plan and the present value of economic benefits in the form of refunds from the plan or reductions in future contributions, known as the asset ceiling. If the pension defined benefit plan allows a company to benefit from the surplus, that the asset ceiling will not apply, hence why the asset ceiling will affect some companies but not others. Let's look at an example how it's applied. In this example, the present value of the defined benefit obligation is £1 million. The fair value of the plan assets, or the pension assets, is $1.2 million. So there is a surplus determined in accordance with IAS 19 of 200. However, if the asset ceiling, the present value of the available future refunds and reductions in future contributions at a discount rate specified in paragraph 82 of IAS 19 is only 170. So how should we account for this difference? The amount that may be recognized as a net defined benefit surplus in this example is $170,000, being the present value of available future refunds and reductions in future contribution. There is a loss of $30,000 due to the asset restriction. This loss is debited to the other comprehensive income. An asset ceiling reconciliation account with a closing credit balance of $30,000 would be created to reduce the surplus to $170,000.